Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. In this video, we're going to talk about bull put spreads or a vertical put spread. This is very similar to a bull call spread, but just the opposite direction. So, our opinion is neutral to bearish, where we will pay a debit for this trade. A bear put spread is also called a vertical spread. It contains two puts with the same expiration but different strikes. The strike price of the long put is higher than the strike of the short put, which means this strategy will always be a debit. This is a debit spread where you sell a lower put and buy a higher put, which will limit your downside profits, but also limit your upside losses. You will pay a debit for this trade and want the stock price to go below the put that you sell by expiration. So this is a directional, more of a directional type of a trade. So if this current stock price is at $20, you will want to buy one XYZ October 20 put. You will sell one XYZ October 15 put, and you will pay a $2 debit for this trade. Now your max loss will be $2, the debit you pay. Your max profit is the $3, and your break even is if the stock closes at $18. Now, from 20 to 18's the $2 debit, and then if we fall below $15, you will collect the full $3, the $3 that you made. So, example, you will buy one XYZ October $20 put and sell one XYZ October 15 put, which is a 5-point spread. You will pay a $2 debit with a $3 profit potential, the difference of the two strike prices. The current stock price is at $20, and you will need the stock to trade at 18 by October expiration for this trade to break even. Your max profit of the $3 would be if the stock closes below the $15 by October expiration, and your max loss of $2 will be if the stock closes above $20 at expiration. This is a bearish spread where you want the stock to move lower and trade below the $15 by expiration. So just so we'll come over here and let's look at the 40-41, right? We would be buying the 41, we would be selling the 40, okay? We will pay a 51-cent debit, that's all we can lose. So when we come over here, right, break even is 49, max profit is $49, max loss is 51. Our buying power is what we could lose max, that's it. Okay, and we want the stock to close below this 40 to keep that, to be able to make the full $49, right? Because it'll be now fully in the money, and it goes from all the way from 49 to $1, right? And that's what our profit would be. So that's how that trade works for the bull put spread. You want price to go lower, and it's a way to put on very cheap, inexpensive risk. And if you're correct, you'll be kind of paid it's a 50-50, right? Think of it that way. So, but you don't have to put up a lot of money. So for trades like Apple, that's $125, right? Or $130, however much. It's a lot of capital if you want to buy the stock, right? Well, here you could do a 1 point wide trade and only literally risk $50 to make 50 and only have to put up $50 worth of profits, or sorry, of capital on that trade. So that is bull put spreads, and we'll see you at the next video.